Hey everybody, welcome to part 2 of our panel episode of Finance This Property That. Last episode, we diagnosed the potential budget changes that haven't happened. Probably by the time this episode airs, we'll probably have a clearer understanding, but as of right now, and the recording of this episode, nothing's happened. So these are just our views on potentially today, if shit hits the fan and everything passes, what's the solutions? So, game, obviously we've got Morgan, Troy and Chris, accountant, financial planner, buyer's agent, and myself, who does the finance side of things, come up with a few solutions around in our particular industry that we look after, our specific niche. So I'm going to start with you because, you know, we left you to last time.
Okay.
You're sitting there so patiently. But
Well, I
you
don't
had-
want to dominate the conversation. You know,
Nah,
there's
mate.
4 of us. Remember, you know, I've been told you got 2 ears, 1 mouth. So,
yeah.
you know,
True,
act
true.
accordingly.
But yours is, I found yours quite philosophical. It was actually really good.
Okay,
Good conversation. So I'm going to lead with you.
Okay.
Not that everyone else wasn't, but mate, property, right? Everyone's talking about property.
Yeah.
It's like, oh shit, this is going to help. Like, mate, given if everything happens the way they want it to happen, with in your opinion, what should people be doing differently? Or what should their mindset be now as opposed to like pre-budget?
Yeah. I think that, you know, the number one thing is most important is sort of, you know, where have the gaps turned up? That's for me the number one question that I always am asking is where is there some low-hanging fruit? Where is there a gap here that doesn't quite make sense? And, you know, we touched on it a little bit in the last episode of, you know, buying existing properties that have got tenants, long-term tenants in them that are for sale, is they're now going to be very heavily discounted because the buyer pool for that particular property has been hit really hard because negative gearing has taken away the investors who would normally be okay to buy that, and then owner-occupiers have got a lot more choice, and they're going, I don't particularly want to buy a property that's got a tenant in there for 8 or 9 months. And so, you know, that's one example, but I think overall that's just one example of where there's a gap, where there's something that was probably particularly valuable that now isn't. You know, another is there a property that's had finance fall over that's been on the market a little while and now it's been there for 4 weeks and buyers aren't looking at it anymore, and you've got a seller who really needs to sell it. You know, it's sharpening the knives. It's looking for those bargains there. You know, another example might be the seller was a bit lazy before they took it to market, and there's a building and pest issue that, look, it's so much, if it's like, oh, there's a building and pest issue, you need to change this, it's $10,000. But a building and pest issue where we're not actually sure what this is going to be, that is risk. And then in a market where it's a buyer's market, a buyer is going to see a greater amount of risk in that. Greater risk, lower price. And so it's looking for those edges. And then if you can stack those edges on top of each other, if, you know, property that's got a tenant in it, it's been on the market for too long because the buyer, the seller, you know, didn't list it at a reasonable price. And then on top of it, some building and pest stuff. It's like, geez, you could really steal that.
Yeah. And are you seeing more and more of that at the moment?
Yeah, yeah, absolutely. Like, I think good real estate agents selling good property, they're still managing to, I guess, grind out a half reasonable deal. That's what I'm seeing. I don't think overall prices have collapsed, at least not in Brisbane, and at least not in my sort of, you know, $800 to $1.3 million range where I play. But there is a lot more gaps of opportunities to go, oh, I'm going to steal this thing that was $1.2 million. Now it's $1 million because there's been a few things that have hit that property individually, but combined.
Yeah. Are you seeing that you have to sharpen your terms, or your terms can actually be a little more on the normal side? Like, you know, we don't need to go on unconditional.
Yeah. And getting finance extensions now is very easy compared to previously of, they might say, oh, we've got another buyer at $20,000 more than you, so I'm happy for you to crash this contract.
Yeah.
Actually, I'd like you to. We're not going to give you a finance extension, whereas now it's, you know, you're getting terms, you're getting the ability to negotiate a little bit harder, absolutely.
Yeah, and I think also the communication piece around, you know, the reason why the finance isn't done, you're talking, everyone's talking, it probably helps the the situation as well keeps people at ease because there's a bit of
Well,
bloody fear going on at the moment.
absolutely. Another one's the building and pest.
Yep.
Like if you have put a house up that's got all these building and pest issues and the buyer comes in and knows that it's a buyer's market, there's building and pest stuff here, I'm going to go really hard. Like as a seller, I think now you've got to put yourself in a position where that can't happen. You've got to deal with your building and pest stuff so that someone comes through and the building and pest inspection comes back and says, oh, there's a few tiny things, but essentially it's okay. There's no major defects. There's not enough for somebody to pull out on because as a seller, what you don't want is someone pulling out for any reason 3-4 weeks into your campaign and then all the momentum's gone and everyone looks at your property and goes, oh, why hasn't anyone bought that? Must be something wrong with it.
It's that sentiment in the market.
Yeah.
Because Jana and I went to see a property in Highgate Hill and it was lovely property, great location. And I'm like sitting there going, they want 2.1 million for this.
Yeah.
I'm like, Jana, there's probably I'm thinking about 1.7, 1.8.
Yeah.
Based on the way it was shaped and the work, the location and the amount of work you had to do with it hasn't sold. And I keep getting a message from them because, they're willing to accept 1.8. I'm like, I'm not wanting to pay 1.8. No, like I don't need the property, but that's the sort of thing that, have you really set the right expectation as a real estate agent?
Absolutely. There was one, a friend called me about it yesterday of a really nice fancy house in Annerley that, they wanted 3.4, took it to auction. Highest bid was 3.2. It's now been 3 more weeks. They didn't take 3.2. He's saying to me, I think I can get this for 3.1. Should I pull the trigger? Going, well, how much further can you push them? Has been my advice because you sound like you're the only buyer really there, and so it's that type of thing. Be smart about it. Don't rush into the first thing. Don't let an agent pressure you because the terms are on your side now.
Yeah, correct. And it's just go slow to go fast, right?
Like
But also, your negotiations don't have to be. I'm finding the terms on the contracts don't have to be as sharp.
Correct.
Like there's no requirement for unconditional, and there's no requirement for 7-day finance and all that sort of stuff, because we're not in that.
Well,
frantic.
If there was, that would impact your buyer pool, therefore your price. We had one we were negotiating on, and look, we actually missed it because it was already, the price was depressed a lot, and it was only found out about it just 20 minutes ago during the break of the episodes, and we were really pushing on it because there was an estate sale. There was some legal requirement that they had to have these particular terms on the sale, and that rigidity made a lot of buyers go, well, I don't want to do that. That seems like a lot of risk to do that. And so we were getting really ready to have a go at it. And then somebody realized, gee, this is a really good deal, and just said yes, but cheaper than what you would have paid.
Yeah. Yeah. So when you get the uplift, you do a bit of a spruce up, you get the uplift on the property. So you made a bit of capital.
Sure.
Yeah. Okay. Well, that's, I guess from that point of view, it's good. Now, are you seeing buyers more organised or less organised?
Probably less organised because there's not that urgency anymore. They don't have to be ready of, I need to have my offer ready and this is exactly how much I'm going to pay for it, and I just want to stop bloody looking at property and buy something. There's not that same urgency in the market, and so they've just sort of taken a bit of a chill pill. Yeah,
well, they can actually, if they've got a plan, they can execute the plan.
There's also fear in the marketplace. Like, I heard from one of our real estate agents that we're really close with. He said he had 6 properties fall over on finance in a week. Right. And he said almost all of them were just people that went, I'm worried about the market. I think that I may have paid too much. I'm just going to pull out. But those are people that wanted to buy, needed to buy, but pulled out because they felt property might fall even further. So it almost feels like now is a really, really, really good time to buy. Once that it gets to that point where there's an agreed stability in the marketplace, then that floor is hit, and then it's sort of, there's not that sort of ability to get the prices that you can. And
it's like buying at the point of the highest fear.
Yeah.
It's probably the best time to to buy.
Absolutely.
Get in, get organised, get in.
100%.
Does that then shift your planning stuff, like with, how much you move to property versus do you put it into shares, because there's no real And what is it? Then they're taxing shares as well. That's another asset.
Yeah. So from our side of things, leveraging different strategies sometimes, obviously buying, good assets. Is it going to be, the right for their cash flow? So if you can't go in and do, like a second or third property purchase, could you do something like debt recycling, where you're not necessarily impacted by the budget changes apart from the CGT component, I should say, but it's also probably comes down to the structure. If you're going to buy an asset, say you want to go buy a big commercial property or a rooming house, are you going to buy that, in a trust, or are you going to buy that in a super fund? In a super fund, we still get our CGT free as of July 1, $2.1 million for mum, $2.1 million for dad, essentially. So it comes down to, like how long you're going to hold the asset. Are you going to be, buying, I think, from our point of view, quickly flipping shares, quickly flipping property is going to become a lot more painful in that sense with the tax repercussions. But if you, have a good structure and you have a buyer's agent that's on your side buying at good value with good metrics on the way in, I think that's really going to help a lot of people, because it comes down to the underlying asset. Like if you buy a shit property,
it'll always be a shit property.
Yeah. If you buy a shit property and you're going to hold on to it, say for 20 years, it's probably still going to be a shit property in 20 years' time.
Well, as is the seed, so is the fruit, as they say. So,
yeah. Wise words.
Yeah.
But
That's philosophical.
but I think if you have someone, if you're not sure about property and where you should buy, I find that, you need your little cohort to help acquire the property, because you're not going to have that, what we've seen over the past few years is where all assets have really gone up. So all the shit properties have also gone up because they've looked like little gems. But I think that, coming into this, you've got more time on your side to make the right decision. So you're not having, to cut down your finance terms or like remove building pests and things like that. I think having the right people, taking the time to purchase the right asset and looking at how long you want to hold it, like it's really simple stuff, but it's the right tax strategy, the right investments, the right finance.
Yeah, because you just touched on something before that I wanted to bring up, because this is going to lead into a couple of questions I'm going to have from Morgan. We were all talking before around SMSF. And you talked about, it could be potential purchasing your SMSF. Now, in the proposed changes, SMSF's been quietly, probably not as badly affected, right?
Well, hasn't had any.
Not
any
really
impact.
big.
yeah, like that's how I perceive it.
Yeah.
The last change is Division 296.
Yeah.
Which is for those who don't know their tax laws, is a tax that just basically goes, beyond 3 million, we're going to add a little bit more tax. That was the last tax change. This budget change actually unaffected. We still get our indexation next financial year. So, it's becoming more appealing for property going forward.
Because I'm getting a lot of inquiry about SMSF. And the first thing I'm saying is, where are you getting the advice? Because it doesn't matter if it's not being touched by the budget. It's still half the time. Like, I remember a conversation we had in our first planning session. I'm like, I've got, a bit of money in super. And you're like, you're not touching your super. Like, it's not happening. Don't bother. It's very like straight down the line advice, right? Because it's not the right time. Are you getting more inquiry around SMSF and purchasing an SMSF? And what's your sort of response at the moment?
We are, and it depends. From our view, it needs to be a sustainable purchase. We can't go in and buy something that's going to be bleeding cash just because you're contributing into super. Like, you're not going to do that in your personal name. We're not going to do that in super. If it's actually going to build your wealth, so if you look at commercial property for business owners, no brainer. Rooming accommodation, also, from that side of things, really good in SMSFs because, you put in such a large deposit. They're pretty cash flow positive. So things like that. Also, if you do pick up a property and there's the potential to, uplift the rental income, becomes a lot more appealing if you know that there's going to be a big CGT event eventually. Also, a good mix, but it's someone that's coming to us with $100,000 in super, on, husband and wife on 90K, you're putting 10 grand each into super a year. The super's not big enough to sustain a property purchase, around the Brisbane sort of area. You're going to be bleeding cash. And what people don't realize is, you're effectively going to have to chip in your own money anyway and contribute it into super in those scenarios. So,
mate, from a finance point of view, it's not frowned upon, but it actually affects every other. If you have to chip in more than your guarantee contribution, when you go borrow in your personal name, you actually have to declare that you're actually doing it. Yeah. And you got to get your accountant. Well, you got to get your accountant to say you either are or you're not. And there's no way anyone that's working with me and if they're coming to you, I'm like, mate, they're chipping in. I'm not like, it's got to work, because then you got to actually remove that, because that's part of servicing. So that's your servicing out of your personal income to prop up the super. And I'm always a believer, like, you've got to buy probably a little bit, the asset that you'd buy outside of your super versus inside of your super almost has to be that little bit of a level up, because it's got to sustain over a longer period of time. It's got a different job to do.
Yep.
Am I going crazy, or is that pretty?
That's pretty apt way of putting it. Like, it's what gets you through as individuals doesn't get you through as a self-managed super fund. Because the gearing benefits all change. Like, the tax rate's 15% in super, as opposed to someone who would otherwise have potentially a 47% tax rates. When you look at the negative gearing of it, well, used to look at the negative gearing of it, potentially is how that would sit. And you go, well, Dion, it makes sense to buy that particular asset in your name because it's heavily negatively geared. But you don't, well, always personal opinion here, but you don't want to heavily negatively gear something in your super.
Agreed.
Or forever.
Well, no, it doesn't make sense, because the tax rate is low. You want to be getting a higher income asset that's going to have, so you're not paying a lot of tax on that cash flow. And I'm no expert on that stuff. That seems pretty obvious though, right?
Yeah. That's the way I look at it.
I'd say the one who knows least about that stuff, and it seems so obvious that that's what you would do.
It's pretty simple. The formula is simple to borrow, right? It is rent plus contribution. If it's services on that, then that's what they literally look at. There's obviously buffers in place, and they shade the rent. And then you basically just have to have enough. I hate it when people use all their money just on the bloody deposit, because there's nothing left over. Because these are the people that don't have the advice. Because there's no way, if they had like 400K, Troy would say, yeah, just dump all the 400K just to meet servicing. Like, that's not, I can't, no one would
Especially with a property that's not yielding well. Yeah. Like, I think it's a different story. If you go, we're going to go buy $1 million commercial property, we're going to chip in, say 30% deposit, and we're going to pay stamps and stuff. We're going to, chip in our contributions from our employer. Could be a different story in the sense that you go, well, there is, a couple of grand a month potentially coming out that we can start diversifying. Where it doesn't work is you go, buy something that's got a shit yield. It's not growing, and you've basically, you're shooting yourself in the foot. You're just like, you may as well just be in a normal retail super fund that's outperforming this whole situation. And look, personally, like, is the deal actually better in your personal situation for that? So no jumping to, I need an SMSF or I need a trust. Like, get the advice, get the right property for the job.
Because, the question I get asked is, if I can't service in here, can I service it in my super? I'm like, well, just because you can, should you? And I'm like, where's the advice?
And the red flags come up. I want to live in the property.
I want to just a holiday home.
My daughter needs somewhere to live. And you're just like, well, in that case, you're going to be paying 47% tax. And, it's not going to be a really good asset.
And that's even more like, I quite like SMSF for diversification a little bit, but when it's the right time and for the right person and when they have the right advice. It's never a first option. It's probably like you can plan it into your like third option. I've seen people come to me and go, oh, got my owner occupied in SMSF. Oh, who told you to get this? Oh, we had a seminar at work. I'm like, oh, what are they doing for you now? It's like, oh, nothing. I'm like, you've got to meet all these requirements. Oh, yeah. But yeah, no one's really told us. I'm like, well, I'm telling you that now. So I've had about 4 or 5 people like that in the last 4 weeks.
Yeah. I think that's where like a lot of people, like that's where they've got a bulk of their savings. Like when you think about us, like we've been working for 20 odd years, that's where a lot of people tend to have their sort of capital sitting out. Like you've got 100, 150, 200 in super and you're, well, how do I get in? Or, you looked at this 6 months ago and people were looking at how do I get in on the property market because it's going nuts. I'm missing out. The only place where I've got cash, because the bank won't lend me money because my serviceability's capped out.
Yeah.
Or super.
Yeah.
You're the answer.
Because then you must be getting a lot of people coming in going, I need to set up super. Now.
Yeah.
Do it now and roll it over now, yesterday.
Well, it's amazing. Like we were talking about this before we started filming. We've had 2 that are looking to set up this month. And you're going, mate, it's the 11th of June.
Like, you can wait.
Do you really want us to set up, prepare a set of accounts, have the audit, everything else for 20 days worth of operations?
By the time that the money's in the account, it's probably going to be like 2-3 days.
Yeah.
So let's be realistic. Like even getting that, like, people forget that, setting up the self-managed super fund is only like one part of the process and you need to roll over all the funds. There's insurance.
Every fund is different.
Insurance
in terms of rolling
implications. There's ID requirements. So, even if you do a nice magical ATO request, a lot of them come back and want ID requirements and verification. So the process isn't instant. And a lot of people are trying to jump really quick.
Yep.
But it's what's the motivation behind it?
I just think it's like people look at it and they've got that FOMO about it. And then especially with budget changes, I think you'll start to see more people go at it and go, well, or not necessarily people, but punters will look at that and go, or someone on Instagram said that buying a self-managed super fund is the way to go.
Yeah.
And then they kind of got to look behind the scenes and go, well, that's how they make money.
Yeah.
Someone on Facebook said this was a really good idea.
And it's just like, well, Dion's got a self-managed super fund, so I thought I'd do the same thing too.
Yeah, my mate, Bill.
Yeah.
But they already cost quite a bit to set up, right? Why would we pay double cost for like less than 20 days? It makes no sense.
And for one of them, it will make sense. Like they're looking to like for that particular circumstance. But for one, it's purely just mate, we're trying our best to talk them out of it. Like, is this really for you?
Yeah.
Might be in a couple of years' time. So let's not get ahead of ourselves. It's
cool. Are you seeing anyone buying in your world in SMSF?
Definitely, it's popped up.
Does your asset change? The type of asset you buy change?
Well, a little bit, but what we're buying for self-managed super funds now is, and it's funny because it's the opposite of what we've discussed as being traditionally a good asset for a self-managed super fund because it probably is negatively geared, but it's sort of that long-term hold type asset where there's some particulars about that property that it's set up in a way that it will naturally outperform the market because of the underlying contents of the land. And that's the sort of thing where you can go, well, all right, it's probably more people that have got a bigger super fund, like they've got a couple of $1 million in there or something, and they're going, all right, well, if I put 400 grand of cash into one of these properties and we just sit on it, leave it in a drawer, buy it depressed, that with a tenant in it for the next 12 months, no one else really wants it on the market. Yeah, I'm seeing that, and I think that's smart because that buyer pool has disappeared. And so there's the ability. But again, it's like it's not necessarily because that's the ideal strategy in a finance sense because it's in a tax sense, it's not. But it's all right, we're buying a capital asset at 100 grand lower than what it would make sense for it to be worth.
All of your super fund.
Exactly.
All of your savings behind
That's
it.
a big key. Is
a big difference.
You've got a multi-million-dollar SMSF. It's got other assets that it can absorb those tax losses.
Exactly.
And then even if the people aren't in pension phase, you hold it for more than 12 months, it goes down to a 10% tax rate for that CGT event. So for those depressed assets where you're just like, still buy and hold strategy, but you're not doing it with, $100,000 deposit.
Yeah.
You're doing it, with a bigger super fund. Your shares and bank interest and things like that are absorbing all those
it's
other.
a diversified part of
Yeah.
a diversified strategy where they probably have other assets that are the opposite of that, of like, probably maybe lower growth but very good in the cash flow sense, and therefore it can balance out. But I'm with you. Someone came over with $100,000 or $200,000 of cash in their self-managed super and were like, "Oh, get me one of these fancy things." I'd probably just be like, "Look, mate, I just leave it in old super or something. I can't help you with that."
Go see Troy.
Yeah,
He
I
might
don't
be
know,
able
yeah.
to get you. He might be able to double your money on black sometime. Or another.
We'll take it down the casino.
But I guess
and
it's
we'll
all
see how
about
it goes.
like in the right circumstances. There's no such thing as a silver bullet strategy. It's like, well, yeah, that would be a disastrous strategy for the person who's not making a lot of money, and it's like it'll end up bleeding them.
Yeah, because from a finance point of view, you also want to be clear on what the goal is as well, right? Like, are we actually setting you up for success? Because they're not easy. Like, yes, even though trusts are easy to set up, an SMSF you need to be so much more organised than an SMSF because you
100%.
can't even sign half the documents.
And what we talk to clients about as well is self-managed super fund land is very different to individual or business land. Like, because we've got to send it off to a third-party auditor. They've got to cross T's, dot I's. You don't have the invoice for that particular plumbing repair or whatever else. They're going to ask questions. And it's amazing how some, like clients that we talk about super funds and everything else that comes to their first year of doing accounts and go, "Why the bloody hell are you asking me for all this stuff? You don't ask it for this." Or like, my company or whatever else you got going on. You're like, "Mate, we've got to send this over to our auditors. They've got to look at it. If things aren't up to what they think is up to standard, you're going to get a bit of a naughty letter behind it saying that, hey, look, we don't really like the fund is what the fund is, but it's a qualified audit report and everything else.
See, I didn't
behind
know
it."
that.
No,
Yeah.
so it's like crossing T's and dotting I's and having that process around it, where it's like if you don't have it, you're going to be up shit creek anyway.
And probably also for the clients that that are always behind on tax returns, business financials, a self-managed super fund is not for you.
No.
You're not organised as
I
us.
started having that thought. I'm like, I don't have a self-managed super fund, and I was like, oh, maybe I should. And then after hearing all this stuff, I'm like, I don't know if that's for me. Especially when you're talking about the receipts for the plumbing and stuff, and I'm like, oh, that's me. And then you brought it up, and I was like, that's definitely me.
Yeah, it's. I think for us, if there's the right intent behind it, if you've got a business owner that comes in and goes, "Look, we want to buy a commercial shed," you can rent it to yourself.
Yeah.
Or you've got something it makes logical sense. Like you've got a big enough super fund, or there's enough inflow, so you can have smaller balances. But like, are all the business owners chucking in $50,000, $60,000 a year to make it worthwhile for that end goal? Like, where are we trying to end up? What are we trying to purchase?
Yeah.
Yeah, and I guess there's some hidden traps. Like that, my next question to each of you guys, right? In your individual fields, what's like a potential trap that people may get into with not being organised or misinformed?
Ooh.
Start with you.
I think having the strategy in place is the one. Like asking the questions beforehand, educating yourself. There's plenty out there that you can educate yourself with. And I think that's the best piece you can have is asking the right people the right questions, having the right people in play because of that, because you've educated yourself on what you're actually looking to do. Because we can't answer these questions for clients, and we ask these clients these questions all the time: is where do you want to go? What do you want to do? I can't answer those questions for you. So you've got to answer them yourself, and then we can help you.
That's literally my first question to every discovery call. Like, what's the goal here? Like, what's the end goal?
Yeah. Makes sense though.
Yeah, but if you educate yourself on that and you find that out and you go, all right, well, this is where I want to go and what I want to do, well, then it makes everyone else like, all right, cool, mate. If that's the way you want to run, we'll make you run 100 times harder to get there because you know exactly where you want to go and what you want to do.
What's a trap you might see?
I think people being really scared of the change as well and going and jumping and changing strategies really quick. So, on the previous episode, we talked about family trusts and people, we've already had conversations with clients where they're like, oh, this might not be the best thing for me. But then you look at their roles, you look at the business they're in, you go, well, you still want asset protection. Yeah. You still, yes, you're both earning, good incomes. Are you really affected by that component? Yes, there's, some flow-on effects with the way that money's going to be distributed and things like that. But I think the big hiccup that people get is, and it's the same with people that invest, when the markets change, whether it's in property or shares, is people try and move too quickly before sitting down, having a chat to someone and going, is this really going to impact me? And, what are the alternatives? If I moved everything into my personal name, what is the impact going to be? Is it actually going to change my tax position? Am I now going to be vulnerable? Because we've had clients that have testamentary trusts in their will. So that changed. If we look through their position, do they still need a testamentary trust? Yes, because they want to protect their kids from future marriage breakdowns. So, you've got $3 million or $4 million going to 2 kids. Who cares if there's a minimum 30% tax on it?
To protect the $2 million, it's worth it.
Do you want to lose $1 million out of a divorce for your child? No. All right. So, 30% tax on someone that's already earning probably $200,000-300,000 grand is not like a bad thing.
Yeah.
But it's a bit of a shame, but it's from our side. Yeah. Take a chill pill.
That's a really good point. I think there's not enough. People talk about there's tax stuff, but there's asset protection. And I think the asset protection stuff to me sort of, I feel like a lot of people just sort of sweep it under the rug a bit of the asset protection, sure. But that example you just gave is such a good example of where a little bit extra sting on the tax is worth it every day of the week for the potential overall savings if something went to shit in that relationship.
Because you look at it that way, mate, and it's 30% on your income or a 50% tax on your capital if you haven't got that right.
Yeah.
Or 100% if you got it really wrong.
Yeah.
If you got a bad lawyer.
Yeah.
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 What about in property?
I think for me, I think the big risk at the moment is people rushing towards new property of going, they've got the tax deductions and all this new property is where I want to be for 2 reasons. The big one of, that's the point of the market that is probably, especially at the cheaper end of new property, is the safest, is the healthiest, has the most buyers still active there, meaning that the discount you're going to get is negligible, potentially zero. And if there's a construction inflation, could go up, and under underlying asset that's not really so fantastic. And then the second part of that is, and I think a lot of investors forgetting this is, okay, I buy a property that's new, I get all these discounts and tax treatment, that's great. But then once I've bought that, it's a bit like buying a new car and driving it off the lot. Yeah. It's no longer a new car. And so the next people, you have to sell that then to an owner-occupier style person, because no investor is going to come in and bail you out. And it just comes back to what we'd spoken about. You mentioned it before about the choice of asset, of buying a good asset. Anyone could have just been a hero in the last 3 years by buying anything, and everything went up. Whereas I think a lot of people are going to get stung like that.
You look at something like, say, for the same money, do I buy something that's potentially 15, 20 Ks around the city, or do I buy a brand new build that's 50 Ks from the city? That there's probably, from that perspective, 500-600 homes have been built in that area consistently. So when you go to sell, what's appealing about your property over one that's just been completed?
Well, and then it's been compounded because all of a sudden it's like the investors, there's no way they're going to go and look at that existing one. They're going to go and say, I'll buy this new one. And so the price differential, the gap between what a new one and what an existing one is worth, is going to grow even more. And so there's a really good chance of people having that negative equity, which, I also want to just put, and this isn't really the point of it, but I'd be really pissed if I was a homeowner who'd bought in Sydney on this 5% deposit scheme.
Now you're backwards.
And I'd bought for, the top end in Sydney at 1.5 million in Sydney?
Yeah,
something like that. Bought for 1.4, and now it's 1.2, 1.3, and it's that deposit I put up just got eaten up, I'd be pissed. Yeah. Like I'd be really pissed.
That negative equity piece.
Yeah.
It's like, it's actually
It's real.
Yeah.
And it will
is.
happen. And I don't think people realize that that is actually something that can happen.
Yeah.
But especially when you look at those are also the most vulnerable when it comes to the interest rate increases. You know, you got someone on like a, $1.3 million loan. It's very different to someone that's, sitting there with a 300K loan, you're also in a low deposit situation or no deposit situation, I should say. So, your exit opportunities to go, shit, cash flow's not great. We're eating, meagering noodles out of a multi-pack. We're really budgeting here. If you are in one of those areas which, will be depressed for a very long time, so there's not like a lot going for it.
Yeah.
It's going to be struggle street. And there's, how are you going to navigate the exit side of that? Because also from the bank's point of view, they're going to want their 200 grand, 300 grand for you to exit.
Well, you're not going to be able to exit. So, so
They'll just be stuck with the property.
Yeah.
Well, the idea is for those 5% deposit scheme is to get off the 5% deposit scheme.
Well, yeah.
It's not to stay on there forever.
No.
And these people
need
are
growth.
actually, you need
To
the
get off
growth. So
this.
you need exactly. So if you have negative growth, you actually now set yourself up like 10 years more that you're paying this higher rate potentially.
And the country is essentially bankrolling those people. So
Correct.
it's sitting on the country's cumulative balance sheet in some way.
Correct.
Should send the memo to Elbow and Jim and just say like, hey guys, you're on the hook.
Yeah. It's coming off your pension. It's coming off your golden handshake. But I mean, from a finance point of view, it's really interesting that you talk about the negative capital, right? So because you can't get out of it. The only way to get out of that scheme is to get back onto like a 80% loan scheme, because there are only certain lenders that do it. And there's a couple of clients that we've helped being able to add a bit of value to their house. It's after 12 months. I mean, they're still staying there, but we can refinance them out because you can refinance them out at 80%, or under 80%. They've got their capital that they actually invested back into the property for the renos, and they could potentially do the next thing now.
They were lucky.
They were very lucky because they bought, and they had the right strategy, right? And come on, bloody jam, right? They've made they had the right strategy, they had the right team. Very, very fortunate, and they weren't in Sydney. So, they afforded what they could afford.
Yeah.
Like there's, based on that. But the trap that people are going to fall in now is rushing into things. You're right. Like, I've got to do it now because I'm going to miss out. No, you don't. You just get a plan together. That's what I'm saying. Let's just slow it down. We've got time. Properties aren't just flying off the shelves like everything else. In saying that, though, rooming houses are pretty we're doing 5-6 conversations a week, and these people are not organised.
But demand's still there.
Sorry?
Demand is still there.
Yeah, rooming, it's going nuts. We're buying land, doing developments. We spoke to like 3 developers this week. So it's ridiculous. But if you're organised, you're actually going to get the better end of the stick, I feel. You got the better you're organised, the better the team that you've got around you, the less yes people that you've got around you. You're actually going to be better off in the long term.
Yep.
And that's the biggest trap that people are falling into is like, people going to brokers that are just writing loans for investment properties because they can service it, but they're only servicing it because of negative gearing, but not explaining to them that's the piece. Now that's that to me is like, that gives me the shits. Can't do anything about it because it's out of my control.
Yep.
But yeah, that's the one move. Like if I was saying, what's the one move I would help a client make in the next 90 days or even the next 30 days is understand what your starting position is, because we're basically resetting the game now. The playing field's reset. That's what I think, because look at what have you got? What is your logical next best step? So finance strategy, get it organized. If you need to restructure only if you have to. Is there the purpose to restructure? And then ask your advisors, accountant, okay, my next purchase, okay, I may need to purchase on this, may need to do an SMSF. Chris, we need to find this type of property. Is that something you can help us with? It's, and we may not have all the answers, individually, but cumulatively, I think we
Pretty much,
we'd come to some sort of way where it's, okay, well, here's all the information from the people that are experts in their field. Okay, what's the best decision I need to make? What's clear? What's not clear? That's my
sounds
first.
fair.
That's what I'm telling every client at the moment. First 90 days. What are you telling your clients? Like, what's the best move they can make right now?
Mate, I think educating yourself across it and just finding the right sources. Everyone's, a source of truth. But I think it's important now that I think you'll see, especially those keen to get into the property space, you'll hear a lot of people in the property space talking about what they think is the right thing to do. But I think around educating yourself on that piece, of knowing who's where and what's what. And not to say that you need to be an expert. You don't need to be a finance broker, accountant, buyer's agent, financial planner, lawyer, whatever else. You get the right people in the right spots, but you need to have an idea of what you want to do.
Yeah, and I think you touched on something interesting there of, there's other people in the space that are giving advice and all that, but also being a level of skepticism around that of like, is there a reason why this guy is pushing me into SMSF stuff or buying these types of properties and building a granny flat? Oh, that's right. They've got a pipeline of these. They've got to do 50 of them a month. Okay.
Yeah.
Maybe that's a reason why. Maybe
And they're building the granny flats out the back of it too. And it's just, just knowing where that's happening because there's a few out there.
Well, exactly. And then having a good team there that can help you and go, is this a good idea? And going, no, it's not.
No, it's not.
Yeah.
It's marketing.
What's your best move for the next? What are you telling your clients to do as your logical next best step?
Logical next best step, I guess, is to really sharpen the knives on property purchases of let's look at a lot of stuff. Let's put in some pretty severe offers and let's not be afraid to buy stuff knowing full well that when that stability point in the market hits and everybody is agreeing that, okay, the market's bottomed out, it's all this, is like that opportunity's gone. And it's like, it's like, there's that thing of, and I feel like a bit of a property spruiker of like, oh, the best time to buy is when, nobody wants to and all that. But
It's kind of true.
It is kind of true.
The old,
It's like,
I'm going to butcher the quote, but it's what does it be fearful when others are greedy and
greedy when others are fearful. You didn't butcher it. You got it perfectly. But within reason.
Yeah.
While also making sure everything else is in line. Just buying something because the market is bad. Like, someone at a house and land package deal out at Ripley who's using that, buy now because, the market is depressed, it's a good time to buy. It's like, but hang on, this is the same price house and land package that was
Your
3
land
months ago.
hasn't reduced.
So like, there's no actual benefit in buying this now. Like that's just manipulative. But of like, well, actually, we're going to buy this for 15% lower than what it was. It's like, oh, okay, now I'm listening. Now that's something that's worth discussing.
I think
Boy.
it all comes down to knowing your numbers. So regardless, you need to know your borrowing capacity, you need to know if you can afford it, you need to know if it's a good deal. Like if you know your numbers and you have a good strategy, it's no brainer. But you need that clear path of, why are we actually buying this? Is it to build wealth? Is it because there's, we eventually want to move into it? Like why are you doing this? Where do you want to end up? And sort of like, where's your current position? Like, can you even do it now? Is it worthwhile doing? But yeah, if it all comes down to, I'm sure Morgan and I are the same with, if you crunch the numbers in that sense and it makes sense, like that's the first tick, and then Dion, from your side of things, like, will the bank even lend you this money?
I think the beauty of like you want to deal in facts, not feelings. Like it's not a what we talk about is it's not an owner occupier, which tends to be a very feelings based piece. It's an investment decision. We're talking cold hard facts. That's it. Facts, no feelings on it. It's either a good idea or it's not. It's a very binary decision. There's nothing in between. That's it. And that's how I think that's the approach to take it, mate. You're 100% right.
Yep. And it all starts with, like you basically just said it. Well, what's the goal? Like, what is the actual end game here? What are we trying to achieve? And when do we want to achieve it by? And that's where you just need everyone in alignment and talking through it. But, man, I'm going to be interesting to see what actually happens after like June 22nd, right? Like, I mean, like we probably be coming back to have a very different conversation.
What happens on June 22nd?
So that's when
Legislative
Yeah,
thing
yeah,
goes
sorry.
through?
Yeah,
I'm
yeah.
guessing. But
So currently in a Senate inquiry piece with the committee and everything else. So it'll make its way into the. Well, I mean, look, God knows, it'll make its way back into the Senate again. We will just wait and see what happens.
Did we hurt enough stakeholders? With the taxes. Oh no, let's adjust it.
Yeah, we shall see.
Yes,
Cool.
it'll be interesting. So, guys, thanks again for coming on. I really appreciate it. Before we go, how do we get a hold of you, Chris? Where do we find you?
I'm most active on LinkedIn. You can search my name. I'm the only person in the world that spells my name like me, so you can't miss me. So yeah, LinkedIn is probably the best place for me. And you can also come to the website, lucidpi.com.
It's Chris McNulty.
Oh yeah, that's right. Yeah. Sorry, I forgot my name.
It's like, how do you spell your name?
But you might have to go onto the
I
show
know.
notes to see how you spell it. Yeah.
Or the previous episodes. Troy, how do we find you?
Just via our website, Willow Wealth Partners. Pretty easy. We offer a 30-minute consultation for any client that might think they need advice. We'll tell you if you do or don't. Some people just need a good accountant, just need a good mortgage broker. So from our side, it's just giving you a bit of a transparent view of, if now's the right time and what the next steps are if you do want advice.
Awesome. We're very similar, mate. It's jump on the website. So we're credit with a bit of a funky spelling, CREDITTE.com.au. You'll be able to book a discovery call off the back of that, get in touch with us or a member of the team and point you in the right direction.
Yep. Same with me. I'm not that hard to find. I'm quite active on Instagram. My reels and stories at Dion Finance Specialist. That could be changing by the time you jump on. And basically the website when it's up and running. Because as of right now, it's not. But July 1st, it will be up and running. But again, we just talk. It's just a general conversation. If you're the fit, it's either fit or no fit. And if we're the right person for you, we'll tell you what the next steps are. If we're not, we'll point you in the right direction or to one of our extended team to make sure you get the right advice at the right time before circling back. But again, I forgot to say this on the last episode, but I'm sure it'll be recorded. The information on this podcast is very general in nature, doesn't take into consideration your personal circumstances. You want to talk financial planning, property, or accounting or finance, come and see one of us respectively, individually about your current situation. But until the next episode, thank you.